Hi guys, I'm going to make this video talking about options risk management for day trading and understanding certain concepts that give you an edge in your trading and knowing what to do. So I'm going to show you my P&L for the day in this trading account, this paper trading account. You can see I'm down 2K for the day, and it's partly because I wasn't nimble enough trading some Facebook options today and Roku options, and I wasn't also aware of my risk management in some ways. So I started the day going in saying I wanted to not lose more than $1,000 in this account. So my maximum risk in the account is $1,000. If I lose more than that, I failed the test. So as you can see, I failed the test. I lost 2,000. But before that, I was actually down 6,000. So it just so happens that I had a few winning trades that helped me out. So as you can see here, if you look at my P&L, you'll see these Tesla puts. I sold them and they expired near worthless. I just covered them. These ROKU calls, I covered them near worthless, and these spreads are now near worthless as well. And you can see these big losses came from these Facebook 205 puts and these Roku 122 puts also. Okay, which I was long and short, by the way. And some of, actually, part of the reason why I'm negative on some of these trades is, well, number one, it's because the risk wasn't managed correctly, and number two, because I wasn't nimble enough in some of these trades, and I reversed my position from long to short, and then I got burned by not taking a break even fast enough, because these options move super damn fast. So the lesson behind this is going to be talking about when you're trading short-term options, understanding gamma risk and how short-term options move a lot faster than a longer-term options, let's say 2 weeks out or a month out or more, you see? Because the gamma is higher. So I can just show you, for example, here on, well, now this is Facebook, they expire today, but my gamma is not showing, but let's see if I show the gamma. Greeks. Let's add in gamma and see what it looks like. So you can see gamma. Yeah, see, look how high that gamma is on these options because they're expiring in an hour from now. The gamma is 80, which means that the rate that delta accelerates is by 80. So if Facebook decides to skyrocket from here, these options are going to go from 43 cents to $4. So that's basically the thing behind it. Now, if you look at gamma on options expiring next week, you can see for the at the monies, it's approximately $4. And the out of the monies, the gamma is slightly lower. Anyhow, and if you go out even further, let's say, you can see the gamma gets lower and lower the further you go out. So the closer expiry options will always have a higher gamma, which is why closer expiry options are more risky to trade because they're more explosive in either direction. Okay, because gamma accentuates the delta, essentially. Gamma is basically the acceleration, so the rate of change for delta with respect to the underlying asset's price. So it's the rate of change of delta. So delta is the rate of change of the option based on the stock price, and gamma is kind of like the acceleration of how fast or slow the delta is going to accelerate based on where your stock price is moving. Anyhow, so let's go and look at some of these trades here. Let's look at the Facebook 205 puts. So as you can see here in the morning, I was selling them because I was trying to buy the dip. Now let's see here. First thing today, the first transaction was made around 9:35. So right around here, I was selling puts right on this candle formation. 3-minute time frame, Facebook dumped, and I was buying the dip, buying the panic sell. So selling the 205 puts at this point. And really what I should have done was just taken a little bit of profit initially, but it was impossible to do that anyway. So what happened after that was I sold, and then at 9:40, wait, let's see here, at 9:40, I sold more on the dip, and then I bought them all back on this break right here. I bought them all back because that was a break of the low of the day. So I did the right thing by covering. I followed my plan, in fact. But what we saw from this is that one thing I could have done better in the trade is I could have had a bit of a wider stop loss. So as you can see, I covered as soon as 205.50 broke at 9:45. 9:45, I covered everything. So right on this break here. So let's say I was entering here at 206.50 max. I didn't enter as high as that, but let's say I entered at 206.50. My stop loss had to be approximately below 205 realistically, but it's hard to see that. You see, like I guess we could have used the support on the daily time frame for reference. So support on the daily time frame was 203.23. That was the support on the daily time frame. You can correct me on that if I'm wrong, but I'm pretty sure it was around there, give or take. 204.50. No, 203.50 was the support on the daily time frame. So moral of that trade is that I should have had a wider stop loss. Sorry guys, here. There we go. Okay. So then after that, I got back in. After I covered, I got back in these puts here. And I sold them around 81 cents, or around 78 cents, okay? So right as we were getting this move here, I got back in selling these puts. So I sold more puts when I saw this retrace right here. And my mistake was not covering them here. I did cover some though. You see that? I covered some, but not the whole position. So after that, volatility dropped off in the market. So I sold them at 70 cents here. And as we were going along, they were kind of here. They were worth about 40 cents, which is great. Volatility drops in the market and it's great. So basically I held them. I held the remainder of that position until I got stopped out, which was near here. Now let's see here. If we go a bit further on the option chain, yeah, you can see around 10:45. 10:45. 1 second. 10:45. I was out, and that was after we broke below 205 here. Interesting. So I bought them back and I went long, I believe. I think I went long these puts here. And then I was selling some up here. I'm not exactly sure of the numbers. So basically I was short the puts and then I went long the same puts as we broke below 205. And I took profit. And actually I was back to break even at one point. So another mistake on this was not going back to break even. I mean, not taking off the trade when I was back to break even. So that's called greed. And that's basically it. After that, I just sort of sold the rest and I was red. And that's it. But I was back to break even at one point because if you look closely here at what these puts did, I sold them off at 170, but they kept going up afterwards. And if we look what they did after, well, they pulled back to $1 when Facebook, what did Facebook do here? Yeah, when we got this in the afternoon afterwards, now we're chopping around, and then we finally broke lower afterwards. So if you look at what the puts did, they only broke out afterwards. But if you can't imagine, I was selling these puts today at 80 cents ish, 90 cents, and they went to $4. So that's why we use stop losses, guys. And I'm selling naked puts here. I'm not selling spreads. But even if you sold a spread, it would have wrecked you. You would have got like lost 4 times your potential gain on the trade. Anyhow, so that's why you got to be nimble with these kinds of options trades. So let's look at Roku. Roku was similar in a way. I traded, no, the 125 calls, no, that was later in the day. That was a profitable trade, you can see, but that wasn't the trade. This was the trade, the 122 puts. So if we're going back and looking, you can see my first transaction was a sell. So I sold the puts where? Right here. That's where I sold them. So we had the initial panic sell move all the way down to daily support. And then at there, I was looking to buy the dip. My mistake there was not selling the puts, then covering the majority as we were touching VWAP. So you have to be more skeptical than not of the bulls when we see a big panic move like that. Roku has been notably weaker. And when we see a move like that, a huge move like that, more likely scenario is just going to be a lower high. So it depends on where we top out. We got the bear entry right here as we were rejecting VWAP, and we do know that there are many algos programmed to buy at VWAP or sell at VWAP in a downtrend. So the algos are selling at the VWAP, and that point VWAP, I've seen it so many times where after a big move up or a big move down, price makes a retest and it will retest almost exactly to the VWAP and then come back and move a second move in the direction. And that's exactly what happened. So my mistake was not covering fast enough. So 955, yeah, see, my entry was great. I sold the puts at 955 and I could have been covering as we were moving up here. and then I could have been out of the rest for break even. But what did I decide to do? I decided to sell more as we were coming down to double bottom, and then I sold more down here. And basically it was a big roller coaster ride. So this was not a high probability trade. And I should have known this was just going to float and just shake out retail traders. That's basically what it did all day. So you can see there was nice selling in the morning, a nice dip buy, but then after that it was slowly loss of interest and then shake out the retail traders for the rest of the day. So this is a bit unclear here of what I did, in fact. So sell, buy some back, sell more, buy some back. I think that was a stop loss, if not mistaken. And then I sold more there, bought them back for lower, took profit, sold more. I don't know. It's a little weird. So anyways, it was red in general. So that was not a high probability trade. I'm not even sure why I traded that. I think at one point I was meaning to buy the Facebook puts back, but I bought the Roku puts back instead. So that's a mistake that is just absolutely stupid. Like, you know, come on. So that's pretty much it. So we can touch on risk management real quick here. So generally, when you're looking to trade these things, very important to understand what your risk is going to be in the trade. So based on where your entry is, so if I was entering here at 124.50, or let's say 124, my risk would have had to be below this low and maybe a little lower. So 10 or 20 ticks below this low would have been my stop loss. So approximately 2.5 points. So whatever my delta is, I'd have to do times 2.5. So if I traded an option with a 10 delta, it would be approximately 25 delta per contract would be my risk. So $25 a contract at that point. Okay. So that means I'm risking $25 a contract. So at that point, I can either choose to take an option with a lower delta if I wanted to have more contracts, or skip the trade because it doesn't fit my risk to reward. If you're risking a point on the stock, anyways, you get the idea, guys. So I'm red on the day here because I did not follow my risk management formula, and we will be continuing to fine-tune our trading as we go forward. Thank you very much. Have a nice day.